My name is Pim. Pleased to meet you. I represent Hawke Point Capital. Hawke Point Capital is an investor in the mining space. We typically invest in equity and see ourselves as partners and want to work collaboratively with management teams to help execute their business plan. We take a long-term view and approach, and are very happy to be locked up for many years in order to get the true value creation that we believe a company could achieve.
Hi everybody, Philip Clegg, Managing Partner of Orion. We're an asset manager focused on all aspects of the mining and metals vertical. The bit that I look after is private capital, so we put together financing solutions to companies that wish to do really one of two things, buy or build, so it's really construction finance and M&A finance. And we invest right across the capital structure in all commodities except for fossil fuels, and it's a global business.
My name is Loni, Saul. We run the Kings Road Capital Fund. It's an equity-focused fund on the junior mining space. We invest from anywhere from early stage exploration to development and production and royalty.
Hi, Ariel Tepperman. I'm at Energy Capital Partners. We do sort of traditional investment banking advisory, so M&A, capital raising. We do a bit of a merchant banking model as well, but for the purpose of this panel, we'll sort of focus on our advisory work.
Hi everyone, it's Juan Alvarez from Nebari here. Nebari is a private credit fund. We specialize in debt, mainly to the kind of the upper junior market, which are getting close to production and cash flow. Obviously, as a debt provider, there needs to be some ability to pay us back. But it's certainly, we're looking at a space that is underneath where the banks and like the traditional lenders will lend to mining companies.
All right, great. Thank you for those. So as I mentioned before, today's topic is really looking at, financing and how to kind of make that environment better for the junior space. So to kick things off, I thought we could really just talk about, what are some of the biggest funding challenges that you're seeing in the market at the moment? Maybe I'll start at the far end this time.
Yeah, thanks, Amy. Look, I think certainly, the smart money is there, right? Like people on this panel, the streamers, the private equity guys, private debt, even the BHPs and the other majors of the world kind of have their, like their junior exploration funds. But how do we get the generalist investors involved? Because that's kind of, like generalist investors will often happily kind of invest in some, like tech company that has similar kind of risk profile to a junior miner. But there seems to be a dearth of investment into the junior mining market, right? Which kind of needs it. So I was kind of talking to a few people like CEOs and brokers and people at the coalface, and there's a real range of reasons why people think that the generalist investor doesn't come into the mining industry. One of the common ones was regulatory, but it was funny because some people were saying, well, the regulatory environment is too tough. We should let we should relax the rules. We should let the market do what the market does best, which is, sort the wheat from the chaff. And others were saying, well, it's too loose. And so you get companies who shouldn't really be there and giving the rest of the industry a bad name. So I think, I'm not sure we'll get to an answer here today, because I think if there was a magic silver bullet, we would kind of have already implemented it. But yeah, certainly one of the challenges is getting the generalist investor back into mining.
Sure, go ahead.
Yeah, I think there's probably, it's sort of like an overdetermined phenomenon. Like I think there's probably many issues. Some of it in terms of the generalist investors, but the nature of them, it's probably more of a macro issue. In other words, when we actually see real indications of rates starting to decline, you see a lot of those investors coming back into the space. I think past that, it's you speak to a lot of Canadians and they like to point to sort of cultural issues of just the interest in the junior mining space leaving the market, and people who traditionally invested leaving as well. I don't know if that's totally the case, but I think past that, you have to sort of look at some of this on a case-by-case basis. So, the factors that have people investing in gold are very different than investing in critical metals and base metals and things like that. I think for gold, there is some issues like where does gold fit into the whole sort of ESG and critical metals environment, which, part of the answer is pretty straightforward. And for then things in the battery sector, I think it's just, that part of the industry is still trying to figure itself out. I don't think people quite know where that sector is going. And, nickel goes from being one of the hottest things one day to not so much the next day. So, what are the issues? It's sort of like, how much time do you have?
Well, I think the generalist investor that has avoided the sector has done well by doing that. Obviously, it's been a tough few years. Fed basically having the rates high up in the last few years have demolished a lot of the small cap sectors, including the junior miners, I think, because when you're looking at a prospect of getting to cash flow many, many years down the line, the increase of time value of money is very, very critical. And obviously, it deters from investors looking into you as a prospect, unless you have a really interesting project that would make a difference. And what I've seen as I look at the sector, for instance, in Canada, TSXV, liquidity rates have come down by roughly 20% year over year until a few months ago. I didn't get the update in the last 1 or 2 months. But when the liquidity has dried up like that, the effect has been that for every company, the amount of money you could raise have come down on average. And obviously, their market caps have also come down. So suddenly, dilution became a very big topic. And the money that was raised were predominantly funding general and admin expenses of these companies to keep the lights on and to keep the companies listed. If their market cap was on the really small side, let's say 10, 20 million, I mean, if we do the basic math, if you are having a market cap of 10, 20 million, and if you dilute by 15, 20% a year, I mean, you're looking at raising 2 million, 3 million a year. And then if your G&A is 1.5, let's say, then you only have another million at most to play with to improve your project, to expand your project. And that money is not that significant to make to answer the questions about geology and other metallurgy or other methods that you need to advance to move the project forward. So in a way, the investors started to fund these companies not necessarily to see results on the projects themselves, but rather to keep the managements on board. And only the really best of the best were able to raise in decent quantities to make a difference in their project. So it has become a very bifurcated market from what I've seen. There have been a handful of winners where they could raise $20 million plus at one go if they wanted to. And they could really advance the project as they planned. And on the other side, there were these struggling, really micro caps trying to get through the day and by diluting themselves and gaining some time, hoping for a better market. So I think that has been the problem. So we need some more liquidity to come in to basically change this dynamic. Or maybe the companies have to have a good look at themselves and argue what they're really adding value in this junior mining space, and maybe slim down their management teams or combine a few ideas together so that their overall expenses versus the money going into the ground, that ratio basically improves in favor of the investors.
Yeah, I think from our perspective, a lot of what we do is project finance, and like I said before, we invest right across the capital structure. So in debt structures, in royalties and streaming, offtakes, and then right into the equity. But the hardest thing right now in our space is the public markets. Equity is very hard to come by, even for some of the better projects. It's quite daunting for companies to even approach the public markets to try and raise that equity, even if it's backstopped by parties like Orion. Very, very difficult because the liquidity is not there. And when it is there, it's only there for a brief period of time. So therefore, timing is really important as well. We are a cyclical industry. So unless you're right now in copper or uranium or something, like it is really, really difficult to access capital in the equity markets, even for project finance. So that's the hardest thing right now.
Yeah, maybe one or two other points that I would add. Stating the obvious, I think there's a lot of capital being taken out of the market by virtue of passive investing. So I think we've identified the generalist or the lack of generalist interest, but that's amplified by passive investing, which particularly hurts the junior industry, I would say. What I also believe to be the case is that not every company out there, and that's a bit to Loni's point, necessarily has covered itself into glory in progressing its project. And truth be told, maybe not every project deserves to be funded, and the market is effectively funding with their feet. It's not a nice thing to say, but I think there is some truth in it. At the same time, juniors are finding themselves at a really tough end of the market. If you only look at what BHP has recently done, they've basically said, I'd rather buy than build. Whereas juniors don't really have that choice, and they have to go all the way to develop and ultimately build. And that's been a tough place to be. And then what hasn't helped either is investors just look at a risk return, and they look at the risk of the mining industry, and we haven't covered ourselves in glory. There's plenty of examples out there of companies that have stumbled. As recent as this morning, another announcement of a company that was quite a well-known name in the London market get put into administration. So it doesn't help the perception either when you can invest in Tesla and the likes and earn a pretty robust return on a risk basis, as opposed to going into an industry that's tough. And then before the weekend, we didn't make it any easier either. There is another company out there that has spiced the results. And if I'm a generalist and I just take these two news announcements over the last week, I'll be like, thank you very much. So I think we're scoring an awful lot of own goals. We on the panel here have a responsibility of identifying that it can be done, and hopefully we can instill some positivity into the market to say we can find the good projects and we can back them and we can put them into production and show that it can be done. But so far, I kind of can't. I know we identified a generalist, but I think they're acting extremely rational in the way they do. And it's up to us to prove them wrong and to show them that we as an industry can perform, can book the returns, and can put the projects into production and deserve their time, attention, and crucially money.
Just to follow on from that, how do you kind of make that determination on what can potentially be a successful investment? Or, what are some, I suppose, keys that you could share with these generalists that might be scared of entering the industry?
I struggle with it. I think you need technical skills. I think you need deep technical skills. And I think the challenge is also that, and I'm delighted that we're in a position that we can do deep technical due diligence and can look at what's behind numbers that are presented in presentations and JORC reports and 43 101s. So I think it will inherently be a challenge for a generalist to do that work and to have that angle. But what they could do is look at the likes of the people on this panel and take some comfort from them and from their track record of investing and hopefully get behind that. I still suspect, though, that when they do the risk return, they're probably more geared towards investing in the late development or early production states as opposed to the exploration states because of the inherent risks and the technical qualities that you need to evaluate those risks. And sometimes, in my view, the ability you need to have to actually get behind the reports that are released at the exchange and look at the real drill database and do the site visits and all the rest of it, which can't always be expected from a generalist.
Yeah, I would add. I mean, I would say if I was a generalist investor, don't be a stock picker. They're not set up for it. I would also imagine that pre sort of 2004, 2003, the beginning of the China super cycle, the generalist exposure to metals and mining pure play was probably pretty small. I think they probably felt like they had to join the party when all these stocks were running, and maybe we're seeing a bit of a reset now to where things were sort of historically.
I would also like to add, in general, when you're looking at the really junior side of the mining industry, buy and hold rarely works. I mean, they're always under time pressure to refinance and dilute. So you have to really keep a keen eye on the financing cycle, the news cycle of the company, and whether your money is going through the ground to really answer some questions that are to be answered. So all these things are important for you to keep track. So you need a really dedicated time frame if you're in that segment of this mining companies. Obviously, if it's an advanced project, then you can take a maybe more longer view and relax, because if there's value that is proven, hopefully time will help you to realize that value. I think some of the critical aspects of success in your question, I think obviously geology is very critical. You need the right set of rocks that can be mined, extracted and processed. And obviously knowing how to finance that operation is very important. Sometimes I'm seeing companies with a good prospect doing a really bad choice of financing, and suddenly they're creating an overhang in the stock performance. And that's sad to see, because obviously you rarely find really good quality assets. So if they're mismanaged on the financing side, that could also hurt investors. And what also needs to be highlighted, I think, is the difficulty of getting social license in today's context in many geographies. So it has been delaying these project implementation timetables a lot, getting permits. I mean, what used to take maybe 5 to 10 years is maybe taking double the time now. I heard a statistic that from the really start to production, the average is now 29 years. I didn't do the study. I don't know how it can be done, but the idea is it's gotten much longer than before. And obviously, time is, when you're investing, time is very, very important. And that delay of time is a big issue, I think, in the financial returns of these investments.
I think it really depends on what kind of investor you are as to the work that you need to do. So, and there's kind of two ends to the spectrum. So there's guys like ourselves that will have, reasonably large funds of say $2 billion, and there'll be sort of 20 average $100 million investments in that fund. So within that context, the amount of diligence that you need to do for each of those investments, it needs to be extensive because you have such concentration of risk. And so that's exactly what we would do. So we look right across the company. We think about not only downside, by the way, but also upside and the concept of optionality around our investments. But in terms of the diligence that you do, it pervades everything. And I would say that ESG actually is now really top of the list. It's something that's just crucial for us and our LPs. So really understanding the sustainability metrics of the company, the frameworks that company would apply, is crucial before we can make an investment. Right through the technicals, like Pim was saying, and really focusing on what is the question you're trying to answer in a diligence process. What is the risk that you need to address? What is the risk that we need to mitigate? Is the team capable of doing so? Is the team set up to achieve what its objective is? And then really, increasingly, because let's be honest, if you get the commodity call right, a lot of the rest can be forgiven. Understanding the market environment in which you're investing is absolutely key. And then on the other side, if you're a generalist investor and you have 150 names in your portfolio of small investors, you just cannot do the same level of diligence. And that's a problem for mining because we are quite a technical industry. And so what do you do if you're a generalist like that? Well, I think you need to focus on where the liquidity is first and foremost, because like you say, you might need to be in and out. And then secondly, I think that, either you follow some of the bigger names that invest in the space, BlackRocks and that kind of thing, and take comfort from those.
Yeah, just to add to that, I think we've probably all read that kind of report or study that said that mining amongst young people is at the bottom of the list of industries of where people want to where young people want to enter, lower than oil and gas, and so mining has this real. It's a dirty word, right? Nobody wants to enter the industry, and the ESG angle, I think, is an opportunity for us, right? The energy transition, we can kind of rebadge ourselves as an attractive industry to enter into, to invest in. All these young people who are on their phones and their iPads have no idea that the metals that go into them have to be mined out of the ground. And so I think that, again, us as an industry have an opportunity to kind of advertise this positive for society. And I don't think we do that very well at all at the moment.
I mean, can we talk a little bit more about that? Ways to improve the public perception for the mining industry. Is a lot of it, do you think, tied to that energy transition discourse and kind of demonstrating what, the potential is moving forward for, EVs and everything else?
I certainly think it's an opportunity to kind of reset, right, the mindset of the public, because we're not going to reset that mindset with gold or iron ore, but we have a chance to reset it with things like that, things that are metals that are involved in the energy transition sector.
Well, I think it's a really crucial point, actually. It is an opportunity for us in the space. We certainly make a big point of it, and our LPs, which comprise, state pension funds of the US, Canadian pension funds, and Middle Eastern sovereign wealth, they don't really want to talk about gold anymore. They want to talk about decarbonisation thematics and how we play into that. And so it's certainly got their attention. I don't think that the mining industry as a whole does a particularly good job of advertising what it does that's good in the world. But I'm not sure what more we could really do.
Yeah, I don't know if I think people tend to think. I think it's human nature to think that if you just sort of change the messaging a bit, it's going to sort of change people's perception. I sort of suspect that if young people sort of see lots of people making lots of money investing in the junior mining space, magically their sort of like aversion to it will change. The critical metals and energy transition space is certainly like the theme that is supporting the mining space at the moment. But I think even that has its own issues, because if mining is now claiming that it's part of the tech value chain, then it's going to be subject to the same ups and downs as the tech value chain will be. And I think that's a very different story than sort of long-term Chinese urbanization, right? When you're saying we're part of sort of battery chemistry now.
I do think if you look back a year from now to here, you can take some comfort that progress has been made. We're not there yet, and I think everything you're saying is correct. But if I look at, and I don't think I'm at a particular aggressive algorithm, but if I look at Reuters, Bloomberg, and Financial Times, the number of articles that they start covering on EV thematics and the sourcing of it, in combination with or spurred on really by BHP approach for Anglo, gives me hope and definitely makes me feel that we have made progress over the last year, and I'd like it to continue. And people starting to jump onto the thematic, and they start to also recognize slowly. But I'm not getting the craziest looks anymore at cocktail parties and the likes when when you mentioned the importance of mining in the EV transition, and that was a very different thing, even 2 years ago. So I think we're making progress. That's not to say we're done, but it is slowly improving. And if we keep just not scoring own goals and progressing what we have in our control, then I'm actually quite hopeful. On the point of young people, we all have a responsibility here, right? So we all have a responsibility to talk to, our children and our colleagues and our friends, because a lot of it is based on misinformation or no information and just simply no knowledge. So there's a responsibility there that we have and we should take very, very serious.
Yeah, I think people take it for granted. Whatever our modern life is based on, obviously it's coming from the ground in different variety of products that we use every day. So it's not, I think, limited to energy transition, which is a good packaging, I agree. But I think whatever we use was mined or grown from the ground. So people just don't think about it and appreciate it. They just go to a store and get it. And they don't think that it had to be created like that. So, and when they see an operation where people are working, mining certain minerals out of the ground, they might reject it if it's in their backyard because it doesn't look as good. So I think that's the missing link. I think, unfortunately, today we as society we've lost touch of the end product and how it's created.
So can I just to jump on something Phil said? I think the question for the junior mining space is really around the gold companies. The gold companies still by number make up the majority of the junior mining space, and they, you sort of see, I think, gold company management teams and boards trying to figure out where they fit into this transition thematic, and how do they sort of convince people that it's better to invest in a junior mining company rather than an ETF or into Bitcoin if they sort of take that view of governments harming their fiat currencies. So I think the question, a lot of that junior mining question of lack of funding for the space is really around exploration stage gold companies, I think.
Before I continue on with my questions, do we have any questions from the audience?
So we've talked about the energy transition and money coming from LPs and the like into the sector for that. But what about energy security? Has there been much pressure or capital flowing into the space, people looking to secure materials, I guess, with China having really quite a strong grip on the supply chain of materials? There's a need for Western countries to start producing, developing materials, but it doesn't look like we can do it half as efficiently as China. Big question there. And just wondering, money pressure, have you seen money coming from there?
I could take that one. So I think the thematic really is deglobalization, and that plays into a number of interesting commodities that we've been looking at and in fact have invested in over the course of the last sort of year or two. And a lot of that is connected with energy. So you can think about the supply chain, for example, for things like rare earths and graphite and high purity manganese. These are all really controlled by China, some of them through the mining and processing, but all of them through the processing of that material. And we don't have in the Western world the capacity outside of China. But we also don't have, this is really crucial across the sector as a whole, but particularly in energy transition, the human capital. We don't have the know-how, right? We gave up on that years ago. And as a consequence, we need to build an industry that is deglobalized if we want to have a supply chain out of China. And that is a massive challenge. So it's a sort of risky investment thematic, but something that needs to be done if we are to have a supply chain outside of China.
Yeah, and on more conventional metals, I'd say the challenge is slightly different in that we do have the knowledge to extract lithium and copper and nickel. at least till a concentrate phase, the challenge really becomes permitting. I see that as a bigger challenge in the non-China kind of OECD supply than I see anything else. I think that the skill set could be solved, the money can be solved, provided that there is a clear track on permitting with milestones that have to be met and that can't be dragged out. The 29 years that was quoted earlier is something that's beyond anyone's horizon. And even if it were to be half, it just can't be done. And we ended up voting with our feet and investing in brownfield operations in an established nickel field where we already had a mining license, because we can't just see how we can risk a decade or more, even with our longer term investment horizon. So I think if governments wanted to truly help diversify their supply away, then one of the first things they ought to look at is their permitting regimes. And I think the capital then will follow. And with that, we can upskill people and get them from elsewhere. But without that permitting hurdle, I can't quite see how you can square this away.
Yeah, I think it's, investors aren't sort of tasked with solving the Western world's problems on energy security. They want to make money for their LPs. I think you sort of see governments trying to step into the fray to figure out different ways to solve this. And the US has one method, Canada is sort of trying to figure it out. Europeans are slowly trying to figure it out, and they're trying to address this permitting issue as well. But time will tell. I think if someone said that a company could get a premium somehow out of having a totally delinked value chain from China, there's sort of a way to address that. But I just, like Phil said, the Western world's not really set up for that at the moment. So, whose responsibility is that? It's not really investors' responsibility. And actually, you're probably at a bit of a disadvantage now if that's your sort of criteria for investing.
Does it follow on from that basically the West needs to take difficult decisions about permitting, but would maybe Mr. Trump might be the most likely to do that, even though you may not like him?
Yeah.
Or
It
something.
was rational. He was trying to cut down the process of permitting within the US. Like, I'll give you one example. There was this project in Alaska, South 32 was involved, and they needed a road to make that happen. They worked on it for many, many years, the Ambler Road. If there is a road, there's a real good copper project, and we're talking about energy transition. Copper is very critical, as one can imagine. So US has this option to create a massive project in the middle of Alaska if they get this road in. And after many years, the company gets the permit, then basically the presidential authority changes in the US, a new federal government comes in, and during the Biden administration, they actually reversed the decision and canceled the authorization. And obviously, as an investor, it's also very, very frustrating when you can't rely on a permitting process that has taken so long. And after all, the company has received the permit to progress the project, and it's reversed. So I think there's I think that the ideology of the governments are very, very critical, especially many of the leftist-leaning governments are against these type of projects being implemented, even though they like to say about how they're pro energy transition, etc. So I think it is important that we need a more business mindset at the level of the government's authorities, who would basically do a quicker job and more open job in terms of the required procedures to approve a project or not, etc.
Thanks. Just to carry on that theme, investors have to be very careful in the US because, if I can give one example, for Polymet in Minnesota, which is quite a difficult state, just before Donald Trump got into power, the Democratic leadership there gave Polymet its mining license because they wanted to get the credit for creating the jobs before Trump came in, because otherwise they didn't want to see Trump running off with all that credit. they got the mining license, they thought, well, hey, we're off. And then suddenly they got hit with a bunch of lawsuits to stop them from doing what they're doing. And they still haven't managed to do it. And then I wanted to mention something. It's interesting, the point that was mentioned earlier on investors being confused as to what some of these companies are, particularly in Canada. You know, are they gold? Are they rare earths? Whatever. Or are they cannabis? And it would be kind of good if the management teams could just settle down and stick to one thing. I mean, I get that the nickel market has been blown up a bit. And so it makes a lot of sense to say, okay, we're going to park nickel for now. Let's go and look for some copper, because that's what the world really wants. And in fact, it's worth mentioning today that copper prices have just hit a new high at nearly $11,500 a ton. And for the first time that I can remember, suddenly all the traders are scrambling around trying to get physical copper to take back into the States to fill in the short positions. And I wonder if this suddenly means that actually the US might not have enough copper for proper functioning markets. Because as Reuters pointed out this morning, China is smelting 50% of the world's copper, and therefore they have control over a lot of the material. So we'll see where it goes.
I think on the permitting front, there is a dividing line where it becomes a bit of a paradox, saying you want to make permitting easier, but you're supporting like an ESG and environmentally friendly sort of approach. But yeah, there's definitely not enough copper. And I think as part of go back to bringing money into the sector, I think everyone here has in their mind of what grades needed to be, had in the ground to make a functioning, economically viable copper project. I think that's going to change as well, because the sort of grades that we were used to they're just not there anymore.
So just being conscious of time, we're just about out of time for this panel. I feel like we could probably go on for another hour, but these guys have meetings to get to. So I thought we could just kind of start to wrap it up with a look, I suppose, at the financing environment moving forward. If you have any kind of thoughts for, what would you share with a generalist, or what would you share with the investors in the room and the juniors in the room in terms of, what maybe some positive thoughts for the industry moving forward?
Well, I would say, we've just closed our fourth mine finance fund, or the initial close at least. And that initial close was quite hard work during the course of last year, harder than it has been historically, for a whole host of reasons connected with just private equity generally, actually. But what I would say is that over the course of the last month or two, the phone has really been ringing. There is a renewed interest in the space, and I think it's a consequence of the run that we've had in copper and gold, and then previously in uranium. And as a consequence, we are hopeful that, there'll be more capital flowing to the sector.
Sorry, phones were ringing by investors or people seeking money?
Prospective LPs.
I think the US generalist market is very, very critical, especially for the Canadian junior space. When US investors show interest and start allocating to the sector, then in a way that liquidity lifts all boats, and suddenly the allocations get tougher. Basically, all books starts to close much quicker at higher levels. So I think US investors' appetite for the sector will be a change of scene when it happens, and I think that's when we will see a re-rating in the sector.
Yeah, maybe one thought from my side is, even if you find yourself as a company in a tough environment, I believe there is ways in which you can make money stretch. What I see all too often when companies raise the little bits of money that Loni is referring to, they're trying to think of ahead at the next fundraising, and they're drilling holes that really don't do anything. It's an info hole. It's almost a guaranteed result, but hopefully it will stand them out and set them in good stead for the next fundraising. What I much rather see a company do is use that money for doing some mapping, which doesn't really cost the earth, but could really help improve your geological understanding. Do more domaining work, do more math work, truly progress the project, that will get people like us really spending time on you and noticing you, as opposed to doing another hole which was almost a guaranteed hole that really doesn't progress the project. So I'd love people to think about their money and think how they can progress the project, as opposed to how they can get the next funding done. And I think that would really help them as an industry and help them as a company, and set themselves up for more successful fundraisings further down the line, no doubt.
Yeah, I mean, what I found working with sort of Pim and Phil and these guys is they want to put money to work in this space. They want to help companies succeed. So I'd say to companies, if you're working with, an Orion or Hawke's Point, be open to ideas and different structures. I think where there's a will, there's a way. And also I'd say, sometimes companies should be open for a little bit more dilution when the market's open to raise money, because when junior mining investing opens up, a lot of people go raise money. So don't worry if it means putting a little extra gas in the tank to make sure you can survive the next downturn. I think take the money and run and move on with life.
Any final thoughts?
Yeah, I mean, I think Pim's kind of hit the nail on the head, right? Like we as an industry have to just put runs on the board, be kind of do things that will make us more successful, and that will then start to attract more funds. So don't be a gold company with a sniff of lithium that suddenly becomes a lithium company, or a lithium company with a sniff of gold that suddenly becomes a gold company, and then just wastes and fritters money away on nothing, and not creating any value.
All right. Well, certainly a lot to consider and take away from this panel. So I want to thank all of our panelists for joining me early this morning. Thank you.